Okay, welcome everyone to today's webinar. I want to do just a real quick audio and visual check. Make sure you can hear me and you can see the screen, just to make sure I'm not talking to myself. If you type in there, yes, perfect. All right, excellent. Thank you so much. So what we are going to talk about today is we're going to go back to day trading. Okay, we have now spent a lot of time on swing trading. We've spent a lot of time on various different strategies already within sort of through the lens of technical analysis, and now it's time to get a little bit more detailed on a couple of things. So before we go into this topic today, we need to give a little bit more context on what the difference really is between sort of day trading and swing trading, and I don't mean this in terms of so much the pros and cons, which is something I talked about extensively in the last webinar, but really more so through the lens of sort of what does it mean from an attention span perspective. And again, there's going to be a little bit of an overlap for the next just couple minutes to what I discussed in the last couple of webinars in the introduction, but it's really important. So let me just make this clear one more time. So for me, for the most part, when we talk about day trading, we're talking about something that really requires you to be looking at your computer more or less the whole day, unless you do it in a certain way which allows you to sort of zoom in or zone in on one or two specific types of trades. So, and that's really what we want to talk about today. We've talked about a couple of day trading strategies, and today we're going to focus on something called a gap. The gap is something we have discussed a little bit before already, and we're going to start looking at gaps and talking about gaps here first on the daily charts, and then we will talk about the gap from a day trading perspective. So we're going to just kind of go full circle with all of this, and just give you everything you need to everything, or at least a good amount of stuff you need to know for gap trading, or how to use gaps, I should say, with your day trading strategy. Now, give me one quick second. I just want to double check something here in terms of the different trades I want to look at today. For those of you, if you have trades that you want me to look at, specific trades, specific stocks, this would be a good time to let me know which ones. Let's see. Okay, so we're going to talk about Apple. We will also look at the S&P 500. We're going to look at Facebook. We're going to look at probably Netflix and Amazon.com. It's a whole bunch of things we're going to do. So, okay, perfect. All right, so I think the best thing to do would be to start off just looking at the daily gap. So let's start off with this, and let's start with the shares of Apple. So first of all, let's quickly define what a gap is. Very simply, to me, a gap here is really what you see here. It's sort of this, lack of price action or lack of volume, I should say, on the chart, and the gap is almost always, and I say almost always because sometimes the gap can be a result of just maybe a new futures contract or something coming in. But when it comes to stock, it's for the most part it's news related. Maybe there's a stock split. Sometimes that can cause issues, or dividends or something like that. But really, we can classify most gaps as being the result of news. And really, what they're reflecting to us is sort of an imbalance between supply and demand. And that's so that's basically what we're looking at here. Okay. So when we look at these gaps, it's also just quickly before we look at it more, it's just most important here is to understand that they are important to respect on the chart. What does that mean? Well, what that means is that when you have a gap take place on a chart, you have an important and a significant action on the chart that needs to be respected. So when you look at an up gap, for example, such as we had here in shares of Apple, this was just a few days ago, you will want to understand that this gap happened for a very specific reason. And the reason for the gap in this case was that earnings, right? So the company reported earnings, and the stock gapped higher. So from my perspective, when I see an up gap like this, I want to respect it, and I don't want to fight it. Okay. So there are really basically two ways of trading, of taking advantage of a gap. One way is to either, when you have an up gap, let's start with up gaps, right? Gaps can also, of course, happen on the downside, like we had, for example, here on the chart. But for the most part, when you have an up gap, you will want to see where that gap occurs and for what reason. Okay. And those are two very specific things that most people just kind of tend to ignore. So a gap that's very forceful will tend to not fill. And when we talk about filling a gap, we're talking about the price going back down here, right? So the stock opened here on this day, and a filling of the gap means that at some point the stock goes back down here and fills this area. Okay, so let's kind of work through the basics, quote unquote, for gaps and what that means for sort of the strategy as a whole. So when we talk about gaps, we need to understand that a filling of a gap basically would be what we call a mean reversion move. So in the case of Apple here, you can see that the stock gapped higher. So if the stock were to go back lower, it would be a mean reversion move for all intents and purposes, although this would have been a very clear statement on the part of investors that the stock, this gap higher, wasn't really something that the buyers had much interest in, right? In other words, this would have been a really big sell signal. So the other thing that people think when they look at gaps, a lot of people think that all gaps fill. Okay, so there's this misconception out there that all gaps tend to fill, which is to say that all gaps that either higher or lower ultimately tend to fill this empty space. And again, the empty space we're talking about is this, right? So when you have an up gap, the misconception is that it would fill to the downside. if you have a gap to the downside, then they would think that the gap to the upside would fill. And while it is true that lots of gaps do ultimately fill, they certainly don't all fill. You know, I mean, we can look at stocks or even big indices like the S&P 500 that have gaps that have been there for 20, 30 years. So it doesn't mean that not every single gap is going to fill, which is exactly what gets me back to the point from before. And that point was that we need to be able to determine why a gap is taking place. Why is a stock gapping up or down? And the why and the where, okay? And the where is really where in the charts, and the why is a little bit more subjective. Or excuse me, more of a subjective type of call. So let me give you a couple examples. Yeah. So Apple here is actually a really good example to start with, which is why I brought up the chart. And essentially what you can see is the stock gapped higher. So after earnings, this is just a number of days ago, the stock gapped higher and it was up here. Well, the reason for the gap was earnings, right? So that the company had good earnings, good outlook. People were probably just under-allocated the stock, they under-owned it. And so the stock had a very easy time to rally higher and yeah, basically, move towards the upper end of the range. So the 2015 highs are now coming into play, right? So the reason for the gap was important enough that we would have wanted to take it serious, which is to say that you probably didn't want to fade it or hope for a fade or a mean reversion move back down to take place. So that's a really important bit of information to understand. Now, a lot of people do gap trades very prematurely, and I will show you this stuff intraday here in just a minute. But what's really important with gaps and any type of trade that you do, and I've talked about this quite a bit now already in this webinar series, is this confirmation. It's really, really important to wait for confirmation. So the where is important and the why. So the why we talk being earnings. The where is the stock gapped higher here, and if you look at the stock a little bit longer term, once the stock got up here, and if you understood the underlying forces that were taking place in the stock, it was not very difficult to imagine that the stock would at least retest, broadly speaking, those at least get somewhere near up there. Okay, and of course that's exactly what happened. So there are two ways you can benefit from gaps. So you can either, like I said before, either gap fill, or you play for what we call a gap and run type of trade, which is where the stock gaps up and then proceeds to rally. Now, there are some very simple strategies that one can apply. So let me just kind of go through the basic one. The very basic strategy for what we call a gap and run strategy, specifically after earnings, is if a stock after earnings starts pushing above either the open or either the close or the open, whichever is higher, or even if you want to be really conservative, the highs of that day. So in this case, you can see Apple reported earnings a few days ago, and then the stock rallied higher, and then on this day, so 2 days after the earnings report, you can see that the stock started to push above these highs, here the closing highs on the day, and we've been rallying ever since, right? The opposite will be true if it happens to the downside. If the stock starts breaking below the lows of the gap day, right? So maybe 2 days later, you can envision that the stock would have maybe pushed below these lows, then that would be a good opportunity for you to try to play this trade, right? To maybe short shares of Apple, or even buy some puts or put spreads or whatever, however you want to express your view. And you can see that the Roboforex platform here is doing a great job to show this very clearly. I have to say that this trading platform is very visibly, very visible and visual, I should say. Excuse me, and everything is very clearly displayed. Not every platform is like that. So, and of course, it is browser based. So I think there's a lot of advantages to having this type of a solution. Okay, so now we talk about the why and the where of the gap a little bit, and we'll talk about it much more. So let's understand gaps a little bit through the lens of risk management, which is a whole other point, which is similar to what I just talked about, but it's really a different point. So let's just kind of talk about this. Well, if Apple were to start breaking into a gap, right? So in this case, let's assume, or let's look at an actual example of where that started, where that took place. So let's go back here and make this a little bit larger. Okay. And you can see, for example, that Apple here had a gap as well. All right. So this gap, this down gap that Apple had here, it didn't really fill until a couple of months, 2 or 3 months later, or something like that. Okay. So once the stock starts pushing into this area of resistance, or into the gap, right, the lower part of this box, and it, particularly when it holds and closes in there on a daily basis, it's definitely worth a shot to try to play that trade to the upper end of the range for the full gap trade. Okay, and the same thing to the downside, right? So like look at, for example here. So I'm going to take this, and I'm just going to, this is the gap here. You can see this bit, right? And you can see that once the stock started pushing in here on a daily closing basis, which is this candle where my cursor is right now, it started to very quickly fill the entire gap. Okay, and that is a strategy in and of itself that we can also apply on a day trading basis. So let's look at this. Okay, so what I'd like to do is I'd like to go to the S&P 500, because the S&P 500 is probably one of the more famous trading vehicles, or not famous is the wrong word, excuse me, one of the most used vehicles for trading on what we call the intraday gap. Okay, so let's look at it a little bit and kind of see what we can do with it. Well, for example, here you can see that the S&P 500 on the 9th of February, which from this day is yesterday, so it's Thursday, February 9th, 2017, you can see that the S&P 500 gapped higher. So on Tuesday, it closed down here, and then on Wednesday, it opened up here, roughly speaking, right? Well, if you were to fade a gap, you'd want to make a bet that this open gap starts to close. And you can see we didn't quite fully close that gap, but we closed at least 50% of it. And that really gets me to a very important point. Okay, and that is that gap fill trades as a day trading strategy, in my opinion, are best done for a half gap trade. What does that mean? Well, it means that instead of trying to make a bet that the entire gap is going to fill, we make a bet that half the gap is going to fill. And you can see from this gap here, maybe the halfway point is probably somewhere around here. Just, you know, this is not an exact science, but that's kind of what I'm thinking about, what I'm seeing by my eye. And you can see that this half gap did fill, but the full gap didn't fill. In other words, the stock, or the S&P 500, didn't actually completely close and go down here. It only went to about the halfway point. So this is one of the common misconceptions as well when people try to do a day trade out of the gap trade, which I think is a great strategy. And again, that's really what I'm trying to explain here to you today. But the common misconception is that the gap has to fully close. And I will tell you that I've so many times have I seen the gap close, you know, halfway or a third or even a fourth, that's a little bit little, but you know, you get the same idea, and then it quickly goes, and then a stock quickly goes back in the other direction. In this case, that will be higher. So it never actually comes close to filling the full gap. Why does that happen? To be honest with you, I'm not really sure. But what I can tell you is that specifically at the midway point of a gap, in this case the downward gap, at about the 50% mark, there tends to be quite a bit of buying pressure. A lot of times, not always, of course, but a lot of times. And I would venture to say it's just because people know that some people try to only let the index, in this case, mean revert back halfway to the halfway point. And so people know this, so then once the stock has made this move, they try to bounce it. And sometimes most of the time well, and I shouldn't say most of the time, but you know, a lot of times they succeed. And sometimes they only succeed for, you know, part of the day before the market then, you know, bounces and then maybe ultimately goes back down. In this case, you can see it didn't do that. Okay, but the halfway point of the gap does tend to fill rather often. Okay, so let's look at, for example, today's gap. I'm just going to zoom out. So this is the gap today. You can see we had another up gap from here to here, and today there was zero attempt at filling any gap. Today we didn't even close a fourth of that gap. But there is a difference, okay, between this gap and this gap. Okay, the difference is on the daily chart. So I'm going to zoom out here a little bit, and now we're looking at a multi-day chart. So what we're looking at here is that on this day, you can see that the S&P 500 did attempt to break above resistance, but it didn't actually. It was still stuck in this big picture range. So as a result, it then bounced back a little bit before that it then went higher. So it basically didn't quite accomplish a what we call a breakaway gap at the open. But today, at least so far, at the open, I should say, we had the stock gapped higher, and then it basically gapped above the previous day's highs, or right to it, right? But what I'm trying to say, it gapped right out of this range, right? It quickly retested that range, but it never attempted to fill this gap here. Okay. So those are very specifically different types of gaps. Okay, the gap here from yesterday, or 2 days ago, whatever it was, yesterday, was what I would qualify to be what we call a common gap. Whereas the gap today is probably more something that we may qualify as something called a breakaway gap. Okay, so let's quickly talk about this and discuss the difference. Well, again, like I said before, a common gap tends to be a gap that happens within a normal trading range. This is your trading range here, and any gaps that happen up or down in between this range are what we call common gaps. And you can see, ultimately, for the most part, these gaps have filled, right? The down gap filled. Although this here we couldn't quite yet tell, but ultimately did fill. Then we had an up gap, that thing filled. And even this one here that we talked about from Thursday filled at least in part. Whereas the gap from today, the gap higher today, was really more what we call to be sort of a breakaway gap, which didn't attempt at all at filling. So those are two distinctly different gaps. And so in general, the general rule is that if you have a gap take place in one direction, and it's powerful enough to break out of technical resistance, most of the time you don't see a big complete mean reversion and touchback of that up gap. Okay, and that's important to understand, because while most people will try to play this gap trade to fade a gap, again, to if you have an up gap, you would be a seller of a stock, and if you have a down gap, you'd be a buyer of a stock just for the gap fill. But there actually is a lot of money, and I would argue over time there is more money to be made if you can find these breakaway stocks, because then sometimes the stock really rallies in another direction. Okay. That's an important aspect about gaps. So it's not just the gap fill that we're looking for. We can also trade a gap based on going in the direction of the gap. But again, it depends on what the type of news is, and again, the type of news can be anything, but the more important the news is, like earnings, or maybe it's a litigation, a company has a new lawsuit, or that new major product launch that people loved, those kind of things. Those are major announcements. Those can really move a stock, and they could lead to what we call a trend continuation, or a runaway gap. If the news isn't so important, then on average, and again I say on average, the stock will tend not to run away, and then you have a much better chance, I should say, at seeing the gap close. Okay, so those are the distinctions, and we'll look at this a little bit more closely now. The other thing about gaps on a daily basis, and again, we're talking about a day trading basis here. And by the way, if you guys have any specific stocks you want to look at for trading this gap, please let me know. Just type them into the chat box, and I'd be happy to look at them. But when we look at gaps, it's also a little bit important to understand what the tendency is of a gap, considering where we are both seasonally, so where are we in the year, and of course what does the volatility look like in the broader stock market. So when you have a very volatile stock market, okay, then on average the gaps tend to be larger, but they do also tend to fill more. Okay, now the trick the tricky thing about volatile markets is that even though they tend to fill more, i.e., we get more gap fills, they tend to be larger, the gaps, and that basically means that we need to trade them in smaller size. Okay. To me, that's extremely important to understand that a gap fill isn't a gap fill. In other words, they're not all created equal. I remember one time, and this is now at this point, this was in 2011. I made 15% in a portfolio over the course of, I think it was about a month, maybe a little bit less. And the only reason why is because of the open gap. The market was so volatile at the time, and we actually traded it through the SPY ETF, and the gaps were so big, and they closed every single day. So we had huge up gaps, kind of like this, but then they much larger. But then the market quickly would come down and fill it. So that's the gaps are very powerful, and if you can, there are two sort of lines of thought about trading gaps. One of them says that you can use the gap to make a steady flow of income, and trading the gap for maybe, like I said before, maybe you played for the half gap, which is what we talk about here. And the other thought says, which is a much more advanced thought, because most people don't think this way. But the other way of looking at it, and I think it's actually a very healthy way of looking at it, is to understand that gaps really are most interesting to trade when the market is very volatile, but choppy, right, like sideways. Because you have these big, huge gaps that will tend to fill. Now, again, you want to make sure you trade with less size so that you don't blow up your portfolio, which would be very counterproductive. But yeah, that's basically what we are looking at. Okay. So when it comes to a couple of gaps that I want to show you here. Let's go through some examples. Okay. So the example I want to talk about here is in a stock called NVIDIA. And NVIDIA today had a beautiful, beautiful gap fill. So let's first look at the chart on a daily basis. So we go to 1 day time frame. And you can see this is the 1 day time frame. So today NVIDIA had a very what we call nice bearish reversal. The day is not yet over, but you can see we have rejected these highs up here. So let's look at this chart a little bit more closely. So let's go back in and use a 5-minute chart. And by the way, you can use a 5-minute chart. You could use a 15-minute chart. It really does, it really is depending on how quick a trader you want to be. And again, I'm not typically a day trader, but we do like to do the open gap trade. So I would like to say that for a gap trading, day trading strategy, it's probably not very wise to use a time frame more than 15 minutes. And I'll show you why. So let's go into the 5-minute chart. And you can see that this is today. Okay, the stock closed last night here, and it opens, I guess, here today, about here. And this looks like this was the overnight price action. Okay. Well, once the stock came into today, you can see it very quickly started dropping. So there was this was a really, really juicy gap fill trade. Okay. I hope you guys can see that. So if we look at this on a 15-minute chart, though, so let's make this a 15-minute chart, you can see that the gap filled very closely. So within just 2 bars, this gap closed. And if we go even further out, like a 30-minute chart, it was just one bar. So basically over the span of 30 minutes, the entire gap filled. So if you had only looked at this on a 30-minute chart and you would have waited for confirmation, then the whole gap would have already been filled and the trade would have already been, the opportunity would have already been passed. If you look at a 15-minute chart, yes, this was a little bit better, and you would have definitely been able to hop on the trade, but you probably would have not been able to trade the half gap because half the gap was already almost filled within one 15-minute bar. And if you go even closer, you can see on the 5-minute bar, now we're starting to get to a point where, you know, once we opened, the stock opened and it started breaking lower, maybe on this bar or maybe even this bar, but I would argue this one's weak enough, you could have played for the stock to start filling its gap. And again, here you would have had a much better opportunity to get in because you're not waiting for so much confirmation because you have a nearer term time frame, and you would have been able to play the half gap, and then ultimately you could have even played the full gap. Okay. Now, specifically, how do you trade? Where to get in? Where to get out? Well, this is something that is very much a personal question. In other words, it really depends on your risk parameters that you set out, what your level of risk aversion is, what your what your account size is, what your time availability is. I think that's extremely important. Your time availability, and really it depends on the instrument as well. You know, not every instrument trades the same, obviously. You know, not every stock trades the same, not every commodity. And I should say, by the way, you can trade this gap in other instruments as well. I find that for stocks, it is an easier trade to do, and I say easy tongue-in-cheek because I don't think anything's ever easy. But I do think with stocks, it's a little bit easier because you have a very well-defined point when the market opens, right? Whereas if you look at some other types of instruments like currencies, they don't really ever stop trading, so the open gap is a little bit more difficult. But if you would imagine here, if you would have done this trade in NVIDIA today, you would have been able to make, let me see if I can find the right tool to measure this. I forget where the percentage measuring tool is. But anyway, the stock, if you would have played this correctly, I would imagine you could have been able to make short the stock around $119 and cover it, you know, in a full gap, maybe close to 114. So that's $5 on a stock of $119. That's about a so 119, 10% would be, let's say 12. So, you know, about 5 or so percent you could have made on this stock, and that's, you know, I think that's a very respectable profit to make. Now, let's look at a couple of other stocks and see if we can find some other opportunities. And I think I would like to spend the balance of today on this type of activity. So let's have a look at, for example, Facebook. And again, before we look at Facebook on the 5-minute chart, let's have an understanding of what the stock looks like on a daily chart, right? Excuse me, before we look at what it looks like on a day trading basis, if there's an opportunity, let's first see what the stock looks like on a daily chart. Okay, so first of all, let's, oops, what did I do? I think I missed it. 1 second. Yes, let's go to the daily chart. Here we go. All right. So this is the daily chart again. We're back. Okay. So what I wanted to show you is that you can see that the stock actually gapped a little bit higher. Yeah, this is 2 days ago, and this move came on the back of an analyst upgrade. So an analyst made a basically bullish comments on shares of Facebook, And while that wasn't really a gap that broke the stock higher, you can see it didn't break the stock higher on a daily closing basis. It ultimately closed higher for the day, so it was what I would consider more of a common gap. Okay, and so there was an opportunity to maybe play it to the short side. So let's zoom in on the 5-minute bar chart and have a look at what it looks like. Okay, so this is today, so we're looking at this day. Okay, this is a couple days ago. So you can see on this day again, the stock didn't break past resistance, right, on the up gap. So it was still a common gap, and ultimately we did come back about 50%. So let's take our Fibonacci retracement tool and measure this real quick. Okay, so measuring from here up here, you can see we did come back exactly 50%. Okay, so this is a really important point, and again, just something that I want to make it very clear that the 50%, the half, we call it the half gap trade, is probably one of the higher probability trades you can ever do. And that says a lot, because there are plenty of high probability trades, although again not very many that can claim to be like 80-90+% profitable. Okay, so I think that's an important, a very important thing to note, is this 50% for tradesmen. Okay, and I hope this is making sense to everyone. And this is honestly probably one of the best tips I can give you. If you're a day trader and you're looking at this, then this is definitely something that you want to look at and consider, this half gap trade. Okay, I think this is an extremely powerful thing, powerful type of trade. Okay, so let's have a look here. What I want to go through now is a couple more examples. Well, actually, no. What I want to go through now, before we look at we look at some other examples, is I want to show you how you can trade this maybe and do a second trade. So what we're focusing on so far is basically once the market rallies and then you see some sort of reversal, to come down and fill half the gap. Well, the other trade you can do is what I call, once you have the bullish reversal after the gap, which honestly is almost, and I say almost as powerful. Okay, and that trade usually happens about anywhere between 15 minutes to sometimes an hour later. Okay. But I would say the sweet spot is between 15 and maybe 30-35 minutes or so later after the open, and it happens after the gap has a little bit closed, and then we start getting a move higher. And you can see here what happened again. We filled half the gap. We also, from a technical perspective, kind of touched back to this point. This wasn't a hugely important point, but it's nonetheless worth understanding. And then we had a strong bullish reversal, and this is why I always say that it's so important to understand these bullish reversals, because if you understand the bullish reversals, you can apply them on any time frame, whether it's a daily chart or a weekly chart or anything in between, right? Or in anything below, right? 5-minute charts or whatever, right? So that's the beautiful thing about being able to understand the strong bullish and bearish reversal. They happen in every time frame, so it's really just a matter of being able to read them correctly. So the strong bullish and bearish reversals also come into play, and that's my point here. They also come into play when we talk about day trading, and in this case, we'll talk about gap trading, right? So really important. Strong bullish reversals happen all the time. We actually just had one here in Facebook. Okay, we're looking at now the chart of Facebook intraday. Okay, so that's today. So this is what we're seeing right now, and we would call this some sort of a bull flag pattern. You can see we had two seller exhaustion candles. So the sellers tried to push the market lower 2 bars in a row, and now we just now had a 5-minute bar confirmation buying bar. Now we're still stuck in this bull flag, right? And if you wanted to be more conservative, maybe you would wait a little bit longer, just maybe see if the stock can get above $134 60 cents or so. But so far, all else being equal, this is already a pretty interesting move. And you can see that the stock just now, over the past 5, 10, 30 minutes or so, has come back and retested what used to be resistance. So that's an important thing to look at. You can see that the technical analysis, again, like I said before, it doesn't matter what time frame we're looking at, whether it's daily or in this case 5 minute or even weekly. It's really the same type of analysis that takes place. Okay, so that's important to see. In fact, let's actually watch this for the next few minutes remaining here to see if we can find, if the stock can find it within itself to push higher. It's now coming into let's see, we're coming into noon time here in New York, and let's see if the stock can get enough energy to push higher. Okay, but nonetheless, whether it does so or not, you can see that the strong bullish reversal not only was very visible here. We had seller exhaustion, 2 strong exhaustion candles, but also we came back and we retested this area that used to be resistance. Okay, and maybe now it's going to be support. So let's watch this for a couple minutes. Meanwhile, I want to look at one more example, and that example I want to look at in shares of Whole Foods. The ticker symbol was WFM. Let me pull that up for you, and what you can see here is essentially again the daily chart, excuse me, the intraday chart, and it's actually very choppy. But what you can see is that the stock basically gapped lower, and then it gapped higher on the following day, which was actually yesterday. So what we had take place here on this chart is what we call a bit of an island reversal. Okay, so let me define this for you. So what you can see is that the stock gapped lower, right? So there's no price action here really in the stock. Then it gapped higher, leaving this empty space in here. It's sort of like a vacuum, right? The absence of volume, so to speak, and the gap down followed by the up gap left a big island here. This is, like you can see, this is cut off from the mainland, right? Cut off from the rest of the price action. So once this happened, you can see pretty much the stock was off the races. And today, the stock, as it looks like it's more or less flat. Let me have a look and go to the daily chart. Yeah, it's kind of reversing a little bit now, but more or less the stock is flat. So yesterday's, this is now the daily chart. So yesterday's trading day was probably quite important, right? So this price action down here, I'm assuming this was after the market closed on Wednesday, was an isolation move, and now we saw a price to the upside. Okay, now we could look, and let's go back to Facebook. I would like to just monitor this for the next few minutes and just talk about it a little bit more. Let's go back to the 5-minute bar. Let me see, yeah, nothing has changed yet, right? So you can see we're still stuck in this range, but again, still so far, the bullish reversal has worked. We found support, and yeah, so if the stock breaks past resistance here, $134 and let's call it 60 cents, it probably has a pretty good chance of breaking higher. But again, it's the bullish and bearish reversals within the context of using it for gaps that is very important. And again, you can apply the same analysis whether it's intraday or a daily chart or the weekly chart or whatever. But again, let me just quickly say one more important point, and I want to quickly look at the chart. Or again, well, I guess we're here. Let's talk about the chart of NVIDIA, which we looked at just a while ago. Okay, what's important that I think is that for a gap trade, you use a 5-minute chart, and I do think a 15-minute chart may be okay, but your 30-minute chart is mostly going to be too long, because the open gap trade actually does happen usually in the first, let's call it, 30 to 60 minutes. If the gap doesn't close by then it usually has a lower probability of closing. So that's what I wanted to talk about today in terms of gaps. I hope this was helpful, guys. If you have questions, as always, you can shoot us an email. Just shoot an email over to our friends over at Roboforex. And I hope this information session on gap trading was helpful. Again, I think gap trading is a highly profitable type of trade. But I think if you're looking for a day trading strategy, this is a really good trade. It's a short trade. It only is valid for 30 to 60 minutes. After that, the trade is usually over. So thank you, guys, and I'll see you in the next webinar.